Hello everyone, and thank you for joining us today. I hope you're keeping well. It is my great pleasure to welcome you to our first Generation Next webinar on borrowing to buy property. My name is Amelia Barbara, and I'm the Corporate Advisory Manager and the Chair of the Generation Next Committee here at William Buck. The Generation Next events have been running for over a decade. The aim of these events are to provide a friendly environment for young professionals to meet, share their experiences and promote their business. Unfortunately, today we don't have that key networking aspect. However, we are hoping that today's session will be valuable for you. This afternoon, you have the ability to ask Malcolm questions during the session using the Q&A feature. We are recording this session today and we will be sending you a copy of the recording in a follow-up email. I'd like to introduce Malcolm Anderson, William Buck Finance Manager. Malcolm is a seasoned professional with decades of experience in financial services, placing a single-minded focus on exceeding the expectations of clients. He has more than 30 years experience in financial services, including heading up a retail division of more than 200 staff for a large institutional bank and with a full service financial services company. Welcome, Malcolm.
Thank you, Amelia. My pleasure to be here today presenting. This is the first presentation I've made to NextGen. It's the only way I can come to these, apparently because of my age, as I'm a seasoned professional. But great to have you on board. Today I just want to cover off some tips and traps of buying a home. More information on some loan products. Obviously some government assistance packages that have come about because of this terrible COVID-19. What's required with lenders in terms of applying for a loan, and just to give you an idea of some of the lenders we deal with. Obviously, the obligatory disclaimer, the information is general. Everybody's circumstances are different, so it's one of the reasons I'm here, is to provide that advice for individual circumstances.
I love real estate. I think people know that. I love to buy houses. I like to sell.
The presenter's a bit topical at the moment, as you might have read in the paper, but this is just a bit of fun ideas in purchasing property.
I love real estate. I think people know that. I love to buy houses. I like to sell houses. When I order a drink, I'd like it to be on the house. And I always want to know what houses are out there, so I'm always looking at the real estate listings. But you have to know how to read them, because they use these secret codes and they put in things that seem positive and they're not. So since I know a few things about homes, and as the creator of HGTV's Ellen's Design Challenge, Mondays at 9, thank you. I thought I would point out a few things to watch for when you're buying a house. Let's look at the first one right here. This one says 2-bedroom, 2-bath condo with potential. You got to look out for that word potential, because potential means that the yellow mold could potentially grow into black mold. Let's see the next one. 1-of-a-kind, 2 bedrooms, 5-bath house. Okay, 1-of-a-kind is another red flag. The builder never made another one because he's in prison, okay? He's been sued and he can't make another one. And what I would look at, who needs a 2-bedroom house with 5 bathrooms? I don't think you need a house, you need a doctor. That's what I think. You don't need that many bathrooms. 2 people in there. Here's another one. Cozy studio apartment. Okay, cozy means teeny, 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 tiny, tiny, teeny, teeny, tiny. If you are the person that prefers to sit in the middle seat on an airplane, this is for you. That's what that place is going to be like. And here's something that seems good. 3-bedroom, 2-bath house, seller is motivated. Seller is motivated means this house is currently on fire. He wants to sell quickly. All right, and very quickly, classic means old, retro means old, Original means old. Good bones, old bones. Newer means about to be old. The on the end. And I hope that helps you if you're looking for a house. And right now I'm going to use my good bones for this dance.
Okay, a bit of humour there to kick off. Now, throughout the presentation, if you have any questions along the way, if appropriate and time is with us, I'll answer them at the time. Otherwise, we'll wait till the end and I'll respond. So just in relation to buying a home, I'm not a real estate expert. However, just to cover off some common sense thinking when purchasing a property. One important thing that a lot of people tend to forget is the costs associated with purchasing a property. And stamp duty and registration fees are a big part of that. Rule of thumb you can use is for a property with a purchase price up to 500, 5% of the purchase price is generally the costs associated to get to settlement on that property. Anything over 500, use 6%. If you do Google William Buck Finance, we will come up, my division, and in that website is some calculators. Included in that is a stamp duty calculator, which will give you exact figures in relation to stamp duty registration when purchasing a property. Things to consider is recent sales within the area and how long a particular property has been on the market. Your real estate agent won't offer this advice, but or the real estate agent that is selling the property, but they should be able to give you that information. They have access to a website, RP Data, which I also have had access to, which gives that information. Another thing to consider is future planning in the area. Obviously, residential is important. We've had a recent situation where a property was for sale and the zoning was actually, back in history, it was residential, but it had recently changed. So it could impact the value and future sale potential of that property. Other things to consider, services within the area. You're close to schools, transport. Other thing to consider is neighbours. That one's probably a little bit more difficult, but I guess you can get a feel for the area just down the street in relation to the state of the properties. You can usually tell when one might be a rental, but yeah, just have a look at the general ambience within the area. If you're really keen, I guess you could go and camp out on a Saturday night and just see what happens in the area. Things to consider is your situation, what your plans are in relation to family. Is it a property that you think will need some improvements along the way, or is it a place as your starting position, and then as you progress through life, career, and your finances improve, is it something that you would look at selling and moving on to something larger? An important factor is head versus your heart. Two considerations here, I guess, is the property an owner occupied, one you're going to live in, or is it an investment? If it's one you're going to live in, it's important that it's one that you love, that you'd like to live in. If it's an investment, it's probably one that you're going to look at the area, the potential for capital growth, and the rental return on that property, which is important. So it's a mix of your price of the property versus your want versus your need for that property, and then the return. Either whether it's owner occupied or investment. If it's owner occupied, you'd like capital growth as well, so that you increase your equity over time to enable you to either borrow against it for other purposes, or indeed sell and move on to a larger property. This is the slide that the real estate agents have access to, and as you can see in this slide here, that's a map of the area where I live actually, and you can see by the colours, various colours, there's over time what the sales have been. If you click on any of those properties, it'll tell you when it's sold and what price it's sold for. It's just a good indicator. So if you're talking to a real estate agent, you might want to mention this particular resource. So loan considerations. We have over 30 lenders on our panel. I think in the 4 years we've been operating this division at William Buck, I've used 16 different lenders. There's so many different policies. While a lot of them are similar, there are lenders that will think outside the square, and what will fit with one lender will not necessarily fit with another. And then it's just a method of putting all the things together that are required by the borrower and seeing where it fits with a lender. Other consideration is owner-occupied versus investment. I spoke a little bit about that previously in the last slide. Principal and interest versus interest only. Principal and interest obviously is more important with an owner-occupied property. You want to be paying down your loan and building equity in your property. Interest only is more aligned to investment, and that would be along the lines of if you have an owner-occupied property with a loan, you want to concentrate on reducing that non-deductible debt or non-deductible interest. And if you've got an investment property, while you're focusing on reducing your principal on your owner-occupied property, you maintain interest only on your investment property, which again maximises your tax deductibility against that particular loan. Variable rates and fixed rates is always a consideration. Obviously, with a variable rate, you're subject to the market in terms of what happens with interest rates. And with fixed rates, you've got certainty around what your repayment's going to be for whatever term you fix a rate for, which is generally between 1 and 5 years. Just with rates at the moment, obviously the cash rate, the RBA cash rate, is the lowest it's ever been, at 0.5%. I can remember, and maybe some of your mum and dads might remember, back in the late 80s when interest rates were 18% for a home loan. Don't know how we survived, but we did. So at the moment, rates have been coming down, aligned with the cash rate. The market is saying, all the experts are saying that, and I'm not an expert in that, but in my opinion, rates are not going to go up for quite some time. The fixed rates at the moment we can get as low as 2.19% for a 3-year period. And even if you go out to 5 years fixed, there's not much movement. In fact, some of them are still lower than the variable rate, which suggests that the rate is not going to go up for quite some time. In terms of loan products, there's generally basic or package. Basic is a no-frills home loan. You get a loan, there's no annual fee, there's no frills with it. It's you pay principal interest. Generally, they do have a redraw facility. If you pay principal reductions in, you can, over and above the normal required principal reduction, you can draw that out at any time, generally using internet. The package loan, in general, it's a $395 annual fee, which enables you to have an offset account. And there's a lot of hype about offset accounts. They're very useful. It's a come and go facility that your salary can go into. You do your normal transactions, and each day, whatever balance is in that account at the end of the day is offset 100% against that same amount in your home loan. The important thing to remember with a package loan is to offset that $395 annual fee at the moment at today's interest rates. You really need to maintain a balance of around $10,000 to $11,000 in that account every day. So if you generally, it's just your salary goes in, you draw it back out until your next salary goes in, it's probably not the product for you because you're not covering off that $395 fee. Relocation loan, they're available for someone who wishes to purchase a new property before they sell their existing property. Not as prevalent as they used to be. but it's still available. Generally, the lender will put in a buffer to allow for probably a longer period to sell your existing property. But you can borrow up to 100% of the purchase price of the property you want to buy. The bank will take security, they'll hold security over your existing property and take security over the new property, the mortgage. When you sell your existing property, the funds are reduced off the new relocation loan, and that is your end loan, which you're then back to normal paying principal and interest reductions. And this product is generally used to enable someone to upgrade their property or even downsize. You don't have to have a debt at the end of that relocation loan. You can simply use it to get into the property you want to get into. If you're downsizing, generally the property you sell is going to result in more funds than is required to repay your existing loan, and therefore those funds can be, a lot of retirees use that when they want to downsize and boost their super. The Family Assistance Guarantor Loan is available generally for young borrowers who don't have the 20% deposit, and in those cases it's family members, but generally mum or dad can guarantee the difference between the 80% and what's required to purchase the property, generally up to 105%, including costs. And what they will do is just provide a mortgage against their house, securing that 20% difference. What happens there is the lender will generally split the loan into the 80% portion and the 20% portion. The borrower is still responsible for repayment on both loans and must be able to show that they can afford the total amount borrowed. Remember, it's only really covering not having enough deposit. What we suggest to borrowers who take out this type of loan is to really concentrate on paying down mum and dad's 20% portion of the loan as quickly as possible, so that mum and dad aren't burdened with that mortgage for an extended period of time. That's very prevalent in the eastern states, where the price of property is quite much higher than here in South Australia. There is pre-approval capacity with loans, and quite a bit of that happening at the moment. We found during COVID that people that were selling properties, the potential purchasers that had a pre-approval were certainly getting a jump on those who were waiting or signing a contract and then applying for a loan. Now, the thing with the pre-approval is, while it's good, what that does is it takes care of the bulk of the assessment of the loan in terms of your affordability. But we always recommend that even if you get a pre-approval, you sign a contract with a subject to a finance clause, just to make sure. There has been instances where someone has had a pre-approval, but when the valuations come in, it hasn't quite come up to scratch and or up to what the purchase price is, and then you find you've got an unconditional contract that you need to settle on, and there becomes an issue in getting that loan across the line. So we always recommend subject to finance clause. Government assistance packages at the moment, and these are, the bulk of them are a result of COVID-19. The first one, the First Home Owners Grant, 15,000, has been around for quite some time. This is a state government funded grant. It's for new dwellings or construction. When I say new dwelling, it's got to be a dwelling that's recently been completed and nobody has lived in it previously. The purchase price of that property or land and building can be no more than $575,000. Both borrowers, if there's joint borrowers, any borrowers must not have owned property previously, and that's either owner occupied or investment, or had shares in a previous property. And lenders include as funds to complete the settlement. So you can use that $15,000 towards the purchase price as part of that 20% requirement for the deposit. The First Home Loan Deposit Scheme is an interesting one. In this one, the government will guarantee the difference between the 80% I was talking about and up to 95%. You must have a genuine, that's 5% minimum deposit, not 5K, sorry. What this does, it avoids lenders' mortgage insurance, which I'll talk a little bit more later. Lenders' mortgage insurance, it's dead money and it can be expensive. You're insuring the lender for the difference between 80% and whatever the purchase price is. For this one, in South Australia, maximum house value is 400,000. In Adelaide, in the capital city, any area outside of Adelaide, it's 250. And the other criteria is maximum taxable income of 125,000 for a single person and $200,000 for a couple. These, with these, the government, this is the federal government, they allocate a certain amount. They initially allocated 10,000 in January this year and another 10,000 in July. They're allocated to specific lenders. The two majors are National Australia Bank and Commonwealth Bank, and then there's a myriad of other lenders. And what has to happen here is you have to be allocated a place on that scheme. So you do that first and then go through the assessment process for the loan. The latest one has been the Home Builder Grant of 25,000. This is in place until December 2020. It may be extended, it just depends where we're at with this COVID-19. It's for a purchase of a construction of a new house or a substantial renovation costing more than 150, but no more than $750,000. Again, the maximum house value for a purchase is 750, and for a substantial renovation, the value of the property can't be any more than 1.5 million after that. Again, the income criteria applies for that one. Lending criteria, this is again pretty general, but security, like I said before, generally 80% a lender will extend against the purchase price of the property, subject to evaluation. Anything over that requires lender's mortgage insurance. And as I said before, that's doesn't insure anything that you're doing. It insures the lender against the difference between 80% and whatever they can have to sell the property for in the event of a default. Lenders will lend up to 95%, including capping the LMI on top of the loan, the LMI premium on top of the loan. If you look at that table, I'll point out that table now on the slide. So this is just an indicative. If property purchase is 600,000, costs including stamp duty, registration 33. So to get to settlement at 633,000. The lender lends the 90% LVR against the purchase price. The LMI premium on that generally 12,150, which you can add onto the loan. So your total loan is 552,000. If you do that, the other issue with that is you're then paying back that LMI premium over a period of time. So you're paying interest on that LMI premium. Credit report is important now. There is a process called comprehensive credit reporting, which anyone holding a credit license, which of course is all the lenders, they must report on comprehensive credit reporting. It's changed recently. They now have to report all credit activity. It used to be just negative reporting, such as defaults, etc. But now if you take out a loan contract of any form, that is reported on in terms of how you've conducted that credit, how you've met repayments, if there's been any defaults, etc. What I may suggest is, if you haven't done it, if you go to a website called My Credit Score, you can get your credit report, and it will give you a score anywhere from 0 to about 1200. If you're on 0, anything below 500, you're generally in a bit of strife if you're looking for credit. But the credit report, if you go on and get your credit report, It's free. You might have to wait a little bit, but it'll give you a score and it'll tell you where that sits on the table. In terms of affordability, lenders will look at the type of employment, your employment tenure, and sometimes, depending if you might have started a new job, but if you're in the same industry, they will consider that as ongoing employment. Income, of course, and in income, lenders vary in terms of what they will accept. Some will accept 100% overtime if you're an essential worker. Generally, it will be shaded to 80%. You have to show consistency of that overtime income, and the same with allowances and commissions. The other thing they're paying very close attention to is spending habits. So when you apply for a loan, you've got to declare your living expenses, and in the past it was simply we spend this much a month, and it was accepted based on if you were a single couple, a couple without children, or if you had dependents, and the lender would say, well, that's about where it should sit for a family of that size. It's now much more detailed, and I'll show you a slide in a minute, just indicating how detailed it is. But it's about what you spend, and generally if you sit down and say, well, what do I spend, and go through it all and be honest, most people get a bit of a surprise, because generally people will meet their commitments, and then there's a discretionary spend that's left. Some do have a dedicated savings record. And if you do take out a new commitment, generally we say, well, that's fine, I've now got to cut back on this or that. With lenders now, they will go through bank statements in up to 3 months, and they will check off, and that's all statements, that's credit card statements, transactional statements. They will check off what you spend against what you've declared. Now, if there's a vast difference, they will look for explanations as to why. It might be one-off expenses, unavoidable expenses, medical expenses, etc. But generally, when we're lodging an application now, if there's a vast variance, we've got to explain that. And if it means cutting back on certain expenditure, then we have to detail what that cutback, or where that cutback will be. Age is now a consideration. Previously, lenders couldn't discriminate when they were lending, but since responsible lending legislation came in, generally anyone that's going to retire, well, they set the retirement age at around 70. So if you're over 50 and you want a loan term of 30 years, you've got to explain an exit strategy as to how that loan is going to be repaid before retirement. And generally that might be super, or you're just going to pay down the loan quicker with accelerated principal reductions. But we have to come up with an explanation as to how that loan is going to be repaid within a certain period. COVID-19 has I've mentioned it before, it's brought in some more stringent policy changes with lenders. They vary across all of them. I won't go into what they are, but it just means that they're just a little bit tougher in relation to what they're accepting. Just a couple of things. I have prepared a couple of articles that have gone out in the past. One is around that comprehensive credit reporting. I think they're available on this presentation, or we've advised a link at the end of the presentation, which you can go in and just have a read of those. And the other one is around living expenses and what lenders are looking for, as I've explained previously. My suggestion is in that article is that if you're planning on borrowing within the next 3 to 6 months, you have a look at your expenses and perhaps budget, knowing that the lender is going to want to have a look at what your habits have been in the past. Now, just on the living expenses, again, that's very detailed, but that's how many sections there are in relation to where your money goes each month. That's just from one of the lenders, but they're all generally very similar in terms of what's required. So just in relation to that, if you get a lot of Uber Eats, then perhaps reconsider that if you're looking at taking out a loan shortly. They will look at everything. Just with the credit reporting too, if you're a user of Afterpay, ZipPay, etc., they will appear on your credit report and will be considered in affordability calculations. In terms of lenders, like I said, we've got a panel of over 30. That's just some of the ones that we've used quite a bit. Again, I would get an average of 10 emails a day across all the lenders advising of policy changes, pricing changes, what options are out there, special offers. Some lenders have a cashback offer if you refinance to them, which more than covers any refinance costs. So day by day, we've got to keep abreast of what's happening with these lenders, so that, as I mentioned right at the start of the presentation, we know whatever your lending needs are, we know where we can direct, or which lenders we can direct our inquiry to, and get the best pricing. Also, with our clients, we will do an ongoing review of their loans to make sure they're still competitive in the market. And if not, we will either go back to the lender we've placed them with and say, well, your pricing is not competitive anymore. What can you do? Generally, we get a bit of a reduction, but if we don't, we'll then refinance as a consideration if it's in the best interest of the client. These are the two articles I was talking about, again, available in the presentation. I think there's some links on there to those articles. So we're down to questions. I only have one so far. I think I mentioned it previously, what will happen with interest rates going forward. And I think I've covered that one live. They're going to stay low for quite some time, in my opinion. So no other questions at this point. I think my contact details will be there. If you've got any following on for this presentation, please contact me around your personal circumstances if you wish, or you know of anyone that might need some assistance with finance. They don't need to be a $1 million client. Please get in contact with me. Just had another question come in. Does doing a credit rating impact your credit rating? I think that means if you apply for a loan, yes, and the application gets lodged, that will be an inquiry on your credit report. So if we're lodging an application and someone, and quite often it happens, someone's forgotten that they've got a new phone, or they bought something from Harvey Norman on interest-free period, because that again is on your credit report. We've just got to explain that. We do have the capacity to get a credit check on our clients that is not recorded on their list, and that will let us know that what the client has told us, their credit cards, etc., what their loans are, matches up with their credit report. And if there's anything on there that hasn't been declared, we can ask what it's about. And generally, it's just a matter of they've forgotten that they did that. Because as I said, it's anyone with a finance services license has to report on the credit rating. But again, go to that website, My Credit Score, and yes, a good idea. No other questions at this point. Thank you for hearing me out. And again, any further questions, please contact me. Thank you.
Thank you very much, Malcolm, for presenting to us today. If you have any questions, like Malcolm said, please don't hesitate to get in touch with him. At the conclusion of the webinar, a feedback survey will pop up. It would be greatly appreciated if you could take a couple minutes to provide us with your feedback. We will send a follow-up email tomorrow with a copy of the recording from today's session. We also invite you to save the date for our next event. We will be welcoming William Buck, Wealth Advisory Director Adrian Frinsdorf, to present an investment market update on Thursday, the 1st of October via webinar. Thank you for joining us today, and enjoy the rest of your day.